Options for beginners. Options come with a lot of terminology that can be really confusing at the start. But once you understand the basic underlying fundamentals of options, it becomes really simple. I'm going to go over 1, what options are, 2, what terminology you have to know to trade options, and 3, what are 2 option strategies that you could use as a beginner straight off your brokerage. Alright, so let's get right into it. What are options? An option is a contract between a buyer and a seller. I'm going to use the example of an insurance company to explain that. I pay car insurance every month, and that is the premium I pay. And in return, the car company can pay my large bills if I ever need repairs. So in this situation, I am the buyer of a contract by paying that premium, and the insurance company is the seller of that contract because they gain that premium, and they are also liable of paying my repairs, which can be really high or it can be nothing at all. That is what an option is. Okay, the first word we have to know is the expiration date. It's also known as the strike date, and this is when the contract is exercised. So for my insurance example, if I do not need repairs by the expiration date, well then the contract is voided, and the car insurance company is not liable to pay me for any of those repairs. And also I'll have to buy a new premium and a new contract to have the car insurance company cover me. So next we have the strike price. And this is the price relative to the stock. It's referencing the stock price. We also see that the premiums are called the bid and the ask. And this is how much the buyer has to pay for the premium and how much the seller gains as a premium. We also have a contract. And the contract of an option consists of 100 shares of the stock. Okay, so now that we got the basics out of the way, I'm going to go into the 2 options that beginners can start trading with. The first is a call option. And with a call option, I am paying a premium for the right to buy the stock at the strike price by the strike date. If I buy a call for $1.04 premium, I am paying $104 for the 100 shares of Apple that I have the right to buy at $140 strike price. If expiration comes and the stock is currently trading at a higher price than the strike price, well then I have the right to buy the stock at $140. Alternatively, if the stock is trading below the strike price by the expiration date, the contract is voided and I lose my premium that I paid. We can also sell a call. Now when you sell a call, you can either sell it covered or you can sell it naked. If you sell it covered, that means you own 100 shares, and if you sell it naked, that means you don't own 100 shares until the strike expiration occurs. So by selling a call, someone pays me a premium, and if the stock ever reaches a price above the strike price on expiration, well then I have to sell it at the strike price. For example, I sell a covered call for $104. On the expiration date, the stock is currently trading above the strike price. Now I'll have to sell my 100 shares at $140, but I get to keep the premium that they paid me. And that's what a call option is. A call option is the right to buy, and a put option is the opposite. A put option is the right to sell. Now, as the buyer of a put option, I am paying a premium for the right to sell a stock at the strike price. If a stock is trading at below the strike price on expiration, well, I have the right to sell the stock at the strike price I paid the premium for. If a stock is trading above the strike price that I paid the premium for on expiration, well, my contract is voided and I lose the premium that I paid. I can also sell a put. By selling a put, someone pays me the premium, and if the stock ever falls below the strike price on the expiration date, well then I have to buy it at the strike price. So when you buy a put, you're buying the right to sell. Understanding options at the basic level and using them to your full advantage can optimize your gains and reduce your losses just by being that add-on to the equity you might buy. So if you like this video, hit the like button and also subscribe, because I post early in the morning when the market opens about stock education, financial education, and the stock market.